The value of Yala. Disclaimer: the content of this video is the author's personal point of view and analysis, which does not constitute any investment advice. If you're interested in this content, please use this link to join our Telegram group, where you will find more timely information and have the opportunity to participate in the discussion. Okay, let's look at Yala's latest quarterly report. Yala is the largest Middle East and North Africa-based online social networking and gaming company. Its revenue 80.9. It's a 80.9 million. It's increase of 7.7% over last year same quarter. Revenue comes from mainly two sources. One is chatting services, the other is gaming services. Its net income 29.7, 79% increase, pretty impressive. It's non-GAAP net income. This one is they took out, I believe, the stock options. This number is 33.4 million. It's 53.8% increase over the same quarter last year. Average MAU, that's the monthly average users, increased by 13.3%. Number of paying users, it's I think it's a decrease by like 4.2%. They said it's due to a near-term game mechanism adjustment. So let's see what happens when this plays out. The next important section, that is the key operating data. Average MAUs, monthly average user, 31, I think 31 million. From that number to 36 million latest quarter. Paying users, that's the decrease mentioned due to the near-term, I think it's gaming mechanism adjustment. So let's see what happens in the coming quarters. The next important section, let's go down. So these explanations, when you read over the quarterly report, pretty much, that's the detailed explanation of their financial statements. So you can go to their financial statements, and then if you find anything that you want to look into further, you come back to this section for explanations. Otherwise, the financial statements will explain everything. But on this part, there's one item, interest income is 6.5 million. So that's a pretty good number. That is due to this company's very high cash position. Actually, we'll look into this in their financial statement. Actually, in their assets, 92% of their assets are cash. So that's a very high cash position. Let's go down. That's the explanation. Okay, their share repurchase program. They have a share repurchase program in place. last quarter they bought some, but seems like this quarter they didn't do anything. So I'm not very happy about this. So they still have like $114.5 million sitting there in their repurchase program. I would like them to take action at this price, to buy more, but I don't know. Hopefully they can do something in the coming quarters. Outlook for the first quarter of 2024, they see the revenues between 72 to 79 million. Some people raised the question, their outlook is actually lower than the first quarter of 2004 is lower than the fourth quarter of 2003. What I see this is, I did a little bit of research on this. If you go to here, okay, this is a spreadsheet I prepared. This is their revenues quarter by quarter. If you look at these numbers, there is clear pattern that the quarter one each year, they have the lowest revenue figure, and then quarter two increase, quarter three is the highest, and then quarter four decline a bit, and then quarter one the lowest, quarter two increase, quarter three the highest, and then quarter four decline a bit. So there's clear seasonal pattern. So that means the quarter one lower forecast revenue figure is not a big concern to me. That's just some seasonal pattern. So quarter one is historically the revenue is the lowest for the entire year. I think probably that's partly due to the climate. For example, if the weather, if the weather is suitable for people to stay home to play games or chatting, they make more revenue. Or there may be some, because in the Muslim countries there are some holidays, festivals, like the Ramadan, those special occasions, that may have some impact on their social behavior. So that in turn will impact this company's income. So that revenue outlook number just a reflection of seasonality. So it's not a big concern to me. So let's go back. Okay, their financial statements. So if you look at their assets, you can see the cash and cash equivalents, that's purely cash. And then restricted cash, term deposits, that's all cash. And also short-term investments, that's also cash related. And then they have, if you look at, they also have long-term investments. That's all cash. So if you add them all together, I did some calculations. These cash or cash equivalents or investments, you add them together, divided by their total assets. That's 92% of cash. So very impressive. If you look further, their cash positions declined a little bit, but that's because they moved that cash into term deposits. Hopefully, that will earn higher income for the company, interest income. And then they also moved some of that cash into long-term investments. So let's see what happens to those investments. Hopefully, it will earn higher returns than the cash deposits. So that's that. And if you go to down a little bit, deferred revenue. Deferred revenue, that, as I understand, is the company collects money from their customer and record it as a deferred revenue. But that's the cash they received but not earned. So they have to provide service to the customer in order to earn that revenue. So the increase of this number means, the future revenue. They have future revenue potential. So that's all it's about. Let's go down. Okay, total equity. So that's also a very important line. So you see their total equity increased from 439 million to 562 million. That is all because this company is making profits. So the profits are added to the equity. Let's go to their income statement. Their revenue, although the quarter-over-quarter there is a decrease, but as I mentioned before, showed in the Excel spreadsheet, that's due to the seasonal factor. But if you compare quarter to quarter with last year, that's certainly an increase. So that's the revenue part. And also, if you look at their cost, that's a little bit increase. So that's not a good thing. But I think they had some explanation in. If you look at, that's cost of revenue, right? If you look at their explanation, cost of revenue. Okay, the cost and expenses. Our cost of revenue was blah 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 increase, and okay, you see, primarily due to an increase in incentive compensation and a one-time game cost related to UI design fees. So there's a combination of one-time thing and a incentive compensation. Incentive compensation, I think that's also related to more work on this part. So that's why they provide incentive for their employees. Okay, let's go back. Income statement. The next item, selling and marketing expenses, that's a decrease in cost. That's good. And general and administrative expenses, it's a little bit increased, but better than last year. And the technology, yeah, that's better. So that's better than last quarter and similar to last year. Also, okay, let's look at interest income. So that's a huge jump over last year. Over last quarter, it's increased by almost $1 million, and over last year, that's increase of like $4 million. So that's all because the interest rate is higher this year than last year. So you can see the interest rate increase is a good thing for this company because they have a lot of cash. If you look at their balance sheet, you don't see much debt in there. So liabilities, accounts payable, a small number. Deferred revenue, so that's not debt. Operating lease liabilities, small number. accrued expenses, so that's operational. So there's no real debt for this company, and they have a lot of cash. So higher interest rate is it's good for this company. Let's look at okay, net earnings per share. They're lower than last quarter due to seasonality, but higher, much higher than last year. But part of that is due to the higher income earned from the interest. So that's part of that. But that's not the only factor. Also, their revenue, business revenue, also increased. So it's a combination of business improvement and the higher cash position and higher interest rate. So that's a combination. Some people raised concerns over their increase in their number of shares. It's a little bit increase, but I see this is normal for tech companies. So that's basically the stock options they offered to their employees. It's increased, but not very dramatically. So I'm not very concerned about that. Okay. Here, share-based compensation. That's the detail of how much shares they offered to their employees for compensation. So you see 884,000 and 1.4 million. So that's a huge increase. So they made explanation. If you recall, they said that's part of their one-time thing and some incentive to their employees. So that's in the most of them are stock options. So they did some work and then they made more compensation. So that's normal. Selling and marketing expenses, you see the incentive is lower. General and administrative much lower, and technology and product development expenses much lower. So if you look at several years time frame, actually this stock options, this figure is on the decline trend. So that's not a big concern. Okay. The next section is reconciliation of GAAP and non-GAAP results. If you look at, they just take out share-based compensation to arrive at the non-GAAP operating income. So it's not a big deal. Okay, that's all I can see from their quarterly report. Next, let's go to the spreadsheet. I did some calculations based on their quarterly report to evaluate the value of this company. This is their total equity from their balance sheet. Intangible asset, that is also from their balance sheet. If you go back, you remember these two numbers, 562, 1.1 million. If you go back to their financial statements, the balance sheet. Okay, if you look at their if you look at their total equity, 562, right? And then they have a line of intangible asset, so 1.1 million, 562. If you go back, 562. You see, just copy it from their balance sheet. So if you subtract intangible from the total equity, you get tangible equity. So that's why I'm doing this is because intangible, it's not something concrete cash, right? Concrete assets. It can be, if you liquidate these assets, it can turn into cash. That's not that type of thing. So, if you evaluate the value of this company, you'd better subtract those intangibles. That's just more conservative approach. So the tangible equity is 561 million. And then their number of shares from their, also from previously their financial reports. So that's this 159 million. So if you divide tangible equity by number of shares, you get a tangible equity per share. That's $3.52. So that's, if this company, for whatever reasons, close doors, sell their assets, everything, if there are any debts, pay them off, that will leave the shareholders $3.52 per share. But the share price right now is around 5. So you see there's a premium of 42%. So you got 1.42 factor. That's sometimes it's similar to the PB ratio. So the stock price divided by the book value. But here, I'm not exactly using the book value. I'm using the tangible equity. So that's actually more conservative on the asset side. So that factor is 1.42. The quarterly earnings is around 0.2 currently. I put a factor of growth 10% on that tangible equity per share. That 10% increase is also a very conservative number in my opinion, because I did some calculations of their EPS, in the past year, the quarterly EPS, and then the average is 0.13, and this year it's 0.1875 average. So that's a 42% increase. But as I mentioned before, a part of that increase is due to the increase in interest rate. But this increase in interest rate is not sustainable. You cannot expect this interest rate increase, forever. So I actually did some conservative estimate. That's 42. Let's put a 10%. I think that's a reasonable conservative estimate of their growth rate. Due to we saw the increase in their revenues and then increase in their cash position. Although the interest rate may decrease, but the cash position will grow quarter by quarter. So that's also a factor to contribute to the growth in their quarterly earnings. So 10% is, in my opinion, is conservative. In 5 years, I did some calculation of that growth. Based on that growth rate, their tangible equity per share will increase to $8.89 per share. If you apply that, the premium 1.42 factor, so that implied expected share price, could be $12 in 5 years. So that's the value of this company. In 5 years, I would expect the tangible equity per share will grow to $8.89, and the share price in turn will reach $12. So that's my opinion. So based on that, if I do some calculations, from $5 increase to $12, the rate of return, if I invest $5 to this company, and in 5 years it grows to $12, the rate of return per year is 19%. That's pretty good for me. So, I'm pretty satisfied with, a 19% increase in my investment. There's another number I calculate, annualized earnings rate. So this number is basically, if you look at the formula, the quarterly earnings divided by the share price. So that's basically, if you invest in one share of this company, and this company earns $0.2 per quarter, and then you times 4, that's the annual earnings per share divided by the share price. So that's the how much money the company can make for you in terms of the earnings rate. So that number is 16%. So that's equivalent of, if you deposit like $5 in the bank, probably today you earn 5.5% at most, right? The savings. But if you invest in this company, you get 16% earnings rate right now, and then over time, that number, because of the 10% growth, you get a more earnings increase, and then eventually, you get a 19% return annually on your investment. So that's just my calculation. So you can do your own work to do your own calculations to see what number you derive. There's another scenario I calculated. Moderate earnings growth, that means 10%. And also they have stock buybacks. If you implement that stock buybacks, let's see what happens. So far they bought 3.9 million. They spent this much. The average buyback price is this number. They had IPO a couple years ago. They issued so many shares at $7.5 price. So that's how much they received from that IPO. And if you subtract what they already bought back from the shares they issued, so this number, if they buy back this much, this many shares, that means they can buy back their all the shares they issued in the IPO at a lower price. If you today it's very easy for them to get the shares like around because today it's around $5, right? So I assume they buy back those shares at $5.5. That's not difficult for them to do. If they do that and buy back all the shares they issued in the IPO, the overall buyback price is $6.21. So that means they can buy back the shares they issued at a lower price than the IPO price. So actually they made over $1 on this operation. So I would recommend the management consider this operation. That's very good for the company. And if they do that, the new tangible equity will decrease because they bought back some shares from 562 million to 477 million, and then but their number of shares also decreased to this. Of course, this is the current situation. They will have some issue some new shares for their employee stock option program, but let's just calculate today's situation. Because in the future their revenue also increase, their income also increase, so that will partially offset their stock options. So, but that's the story for the future. So let's look at today. The number of shares will decrease to this number, and then a new tangible equity per share is kind of lower. That is because they still, although their purchase price is lower than their IPO price, but that price is still higher than their tangible equity per share. So that means that buyback operation will decrease their new tangible equity per share to this number. But because they bought back a lot of shares, their earnings per share will increase from 0.2 to 0.22. And then if you still go with 10% growth rate in 5 years, actually their tangible equity per share will increase to 9.25%. So that's higher than if they don't do the buyback. So buyback, actually in 5 years, it will increase the new tangible equity per share. Although today it's lower, but because the earnings is higher due to reduced number of shares, actually they'll grow their tangible equity per share at a faster rate. So eventually the number is higher, and then the premium is premium factor is 1.51. That translates to a expected share price 13.99. That's also higher, and then also annualized earnings per share, because the quarterly earnings per share is higher, so that earnings rate is higher, like 17.7%. So and also the other thing is, if they do stock buybacks, that will most likely to accelerate the growth of their stock price. So this stock price will increase faster than if they don't do the stock buybacks. So that's why I'm not very happy with they didn't do any buybacks in the latest quarter. I would encourage them to do more buybacks in the coming quarters. That's very good for the growth. The value, the growth of the value of the company. Okay, that's all for the quarterly report. I also look at the investor section on Yala's website when I did my research on this company. If you go to their news releases, here they have all their news releases since they IPO of this company. I read through these news stories, and there are a couple of things particularly interesting to me. If you of course, I got their initial IPO data here, and their previous earnings, all the previous earnings report, and there is oh, okay, this one is particularly interesting. Yala Group Limited responds to short attack reports. So there's one instance, some short sellers issued some reports about this company, accusing them, make some false data, I believe, representations, and then I followed this story later on. If you look at it here, okay, here, Yala Group announces dismissal of security class action lawsuit. If you look into this story, this company, you see here, lead plaintiffs in a security class action lawsuit against the company and its CEO voluntarily dismissed the lawsuit in January 12, 2022, which marks successful and final conclusion of the lawsuit for the company. So, this company successfully defended an accusation, the fraud accusation of this company. This makes me feel, have a little bit more confidence on this company. And also, there are other interesting stories. They won gold at 2022 Middle East and North Africa Stevie Awards, and top 2030 overall EMEA headquartered publishers, and there's also a report they mentioned, I think it's let me see. Actually, there's Fortune 500 in Arab area. So where it is, Fortune 500. Let's go to there. There's something. Oh yes, yeah, Fortune 500, Arabia. So Yala Group secured on Fortune 500 Arabia list, but why I couldn't find it in the news section? I used to see this news story in there, but anyway, you see it in here. And also the other place to research this company, if you go to their investors, if you want to do more research on this company, you go to financial information. There's SEC filings and quarterly reports and annual reports. All of these resources you can look at. For the SEC filings, the particular important 20F. That's their annual report for foreign companies. And then there are also, if you look at 13G, this is also very important. If you look at this, this shows how much shares the insider hold they hold shares of this company. So you see these numbers, how many shares? Yeah, you can look at all of these very important information. And also, I also did some research on their software, their products. This is their voice chat room app. If you click on that, they have over 100 million downloads. So that's a pretty big number, very good. And also, there's another. Also, this one is also their earliest, more mature product. If you click on that, there are also over 100 million downloads. And then there are some newer products. The downloads are lower, I think 5 million. So just started this software. There's another one, 1 million. So they have some old products and new products, and for their old products, they have over 100 million downloads. So that means if you recall their average monthly active users is in the latest figure is 36 million. So they have over 100 million downloads. So that from one angle, that's something gave me more confidence of their average users number. So users 36 million, downloads 100 million. So if you compare those two numbers, seems to be the users numbers are reasonable. So this type of information, if you want to look deeper into this company, you can do your own research from their website, investor section. There are a lot of information in there. The risk of investing in Yala. First is the regulatory risk. Any changes in government regulations regarding Yala's business may have profound impact on its profitability, but we have not seen any signs of this happening. Second, some people mentioned the risk of investing in Chinese companies because there were instances of fraud associated with some Chinese companies. But although Yala's ownership, its management, and some of its business functions are associated with China, it's essentially a company headquartered in Dubai with its market in the Middle East countries, and it does not rely on the Chinese market. In the past, there was one instance where Yala was accused of fraud by some short sellers, as I mentioned in the previous news stories on the company's website. But the company successfully defended itself and prevailed in the court, and the class action was voluntarily withdrawn by the lawyers. Those Wall Street lawyers, it's not easy for them to withdraw a case if they see any opportunity to get the company, right? So the fact that they withdrawn from the case means they did not find anything on the part of the company. So from this case, I get a lot of confidence on this company. There also are some other risks that you can refer to the company's annual reports, but I view these two as the most significant risks. The factors that offset the aforementioned risk. Yala's headquarters and market are in the Middle East, not in China. internal ownership of the company's stock is over 50%. Therefore, the management has every incentive to not doing anything that is detrimental to the stock price. The company is very profitable and its profitability is very stable. When the company is very profitable, the management will not, kill a goose that lays the golden egg. Okay. Uh, and also somebody mentioned that the stock price of this company is only $5 or the trading volume is very low. But my answer to this is the investment value of a stock has little to do with its stock price or its trading volume. The investment value of a stock is determined by the ratio of its stock price to the value of the company. So that ratio determines the investment value of a stock. Okay, this is the jump. Hopefully, it's the jump of the stock price. Uh, okay, if you are interested in this video, you can subscribe to my channel and click on that reminder bell so that next time when I upload a new video, you'll be reminded. Uh, Thanks for watching.